Good afternoon. Good afternoon, and welcome to the Sage Investing webinar. My name is Jen, and I'm one of the co-founders of the Sage Investing Group, along with Maggie and Lana. So some of you guys probably don't know this, but they are actually on the road this week. They are traveling to the Carolinas and in Georgia, and they're there to visit some of our brokers and to also tour some properties. So I'm really appreciative that they are here with us today to join us on this webinar, despite being on the road and traveling and probably really tired. So welcome, Maggie and Lana. So before we kind of get started, can you guys just let me know if you can hear and see the presentation? Just type it in the chat box really quick. And while you guys are in the chat box, I want to let you know that anytime during the presentation, if you have any questions that pop up, just go ahead and type those questions in the chat box as well, and we will address them at the end of our presentation. All right. Sorry, I can't really see the chat box. Maggie and Lana, can you see it?
Yes, we can, okay. And the audience can see and hear you.
Okay, perfect. Thank you. Thank you. All right, great. So today we're going to cover the topic to answer the question, how you, the limited partner, get paid in a syndication. So some of you who were on our last webinar know that we did kind of review it a little bit last time, but today we're going to dive deeper so that we can help you understand these key return lingos that you'll commonly see on investment presentations, and will reinforce what they mean with an example. So before we get started, I just want to do a really quick intro about ourselves. Sage Investing Group was founded in 2020 through the merger of JPW Acquisitions, which was my company, and Athena Wealth Capital, which is Lana and Maggie's company. So all three of us, we actually hailed from the Big Four accounting firms. So all of our background is rooted in audit and risk management. And I know people will sometimes run the other way when they hear that word audit, but I promise we are on your side in this situation. We are using our 35 years of combined professional experience in audit, accounting, and finance, along with our real estate investing background to do what we do now in multifamily syndication. So because through our own journey, and through our own research and through our own trial and error, we came to the conclusion, all of us came to that conclusion, that multifamily is actually one of the best asset classes to invest in by far. So the deals that we present to you have been critically vetted by all three of us, so that hopefully busy professionals like you guys will have a little bit more confidence when it comes to investing in these real estate syndications. Today, our group has over 175 investor circle members, and we have over 450 Facebook followers. And collectively, we have participated in 14 deals in total, which adds up to over 3,000 units and a portfolio size of over $350 million. So as I mentioned earlier, we do truly believe that multifamily is one of the best asset classes to invest in out there. And we would ultimately love to have you guys partner with us on future investment opportunities. So we've created this webinar to help you guys make that educated investment decision. So these webinars are for you if you have tried to ever invest in a syndication but ended up backing out. Or maybe you've invested in a syndication, but then you felt like you didn't really know enough about it before jumping in. Or third, you just haven't even started yet because you feel overwhelmed by all the information that's out there. And there is a lot, so we understand. So as we said, this webinar is for your education purpose. And before we go in deeper, I do need to make this disclaimer that, although we have a CPA background, Sage, we are not a legal, financial, or a tax advisory firm. So please consult with those respective professionals if you have specific questions related to those type of topics. We'll be also sharing some numbers with you in this presentation, and just know that we cannot guarantee any returns. These numbers are just to show you, give you a ballpark of the types of returns that you might expect investing in these syndications. But you know, all investments all have risks, and nothing is really guaranteed. Now, after today's session, we hope that you walk away being able to recognize these key terminology that we're going to go through with you, and that you'll be able to understand what they mean when you see them on investment presentations. And we'll also actually share with you guys an actual investment that is in our portfolio. And we want to share with you guys the progress that it's making so far 1 year into the investments, just so that you can see a real life example. Now I'm going to have Lana kick off the webinar for us with some key terminologies.
Thanks, Jen. So as you can imagine, different operators have different ways of showing their projected returns on their investment presentation. I'm going to take a minute to just quickly cover some of the more common terms you might come across so that when you see them, you'll be able to recognize and understand them in any format they're presented. So some of the common terms that we'll be covering today include preferred return, cash-on-cash return, total return or equity multiple, internal rate of return or IRR, and finally, the LP-GP split. So here's an example slide of an investment return similar to that of a past deal that we had offered. I'm going to cover each box and share what they mean for you as an investor. So in the first box, 8% preferred return to investors plus 70% above pref. It's actually telling us two things. The first part, 8% preferred return. It's saying that investors are going to get the first priority of returns over GPs, up to 8% of their investment each year. Keep in mind, this isn't a guaranteed number, but it is preferred, which means you get first dibs of the profits generated from the property that year. The second part, 70% above pref, it's just saying that if the returns end up being more than 8%, then anything above that 8% gets split. In this case, 70% to investors and the remaining 30% to the GPs. We'll talk a little bit more about the LP-GP split in a little bit. In this box, projected annual cash-on-cash of 10%. It's saying that the cash-on-cash return, which is really calculated as cash income that you may earn on the cash that you invest each year, is going to be 10%. That cash-on-cash return is what you can expect to receive in distribution each year from this deal, usually in the form of a check or a direct deposit. In this case, the cash-on-cash is 10%. So had you invested $100K into this deal, the cash-on-cash distribution expected would be $10,000 each year. Notice that the 10%, the cash-on-cash of 10% is exceeding that 8% preferred return we just talked about. This is implying that for this deal, the projected annual cash performance is not only going to meet that 8% preferred return, but actually exceed it, which is a good thing. So in this box, projected total returns on investment of 111%, it's just saying that the accumulation of the annual cash distribution we just calculated, plus your share of the proceeds from the eventual sale of the investment property is going to be 111%. So for this example, if you had invested the $100,000 that we talked about and your projected return is 111%, that would calculate to be $111,000 at the end of the investment period. This doesn't even include your original investment amount. This is the amount of return above the cash you actually invested. This can also be expressed as an equity multiple, which we'll cover next. So the equity multiple is a multiple of your total return, including the amount that you actually invested. So going back to that same example, if you invested $100,000 to this deal, it's projected that you would get your initial $100,000 invested back, plus another $111,000 that we just calculated together based on the annual cash distribution and proceeds from the sale. That's a total of $211,000 or 2.11 equity multiple. Another way to apply this 2.11 equity multiple is just taking your $100,000 of invested cash and multiplying it by 2.11 to get to $111,000 total return. IRR, or internal rate of return, it's just the rate of total return, but it's also taking into account time value of money. Now, the calculation for this can be somewhat technical, but it is a helpful point of reference for investors who are looking across multiple deals as a way to compare returns on a relative basis. So for example, if you're looking at two different deals and assuming all else being equal, such as deal performance projections, including cash and total return, except one of the deal gives you your return in 3 years, another deal gives your returns in 5 years, the IRR for the 3-year deal is going to look better or higher because return is being shared to you sooner. In this case, for this example deal, the IRR was 18.5%. So it's just one of many points you can use as a reference to compare with another deal that you may be considering investing in. So I briefly touched on this earlier under the 8% preferred return box, but what this box, the 70-30 LP-GP split, is telling you is just how the profit is going to be shared between the GP and LP. And in this deal, this split will be after the LPs have first received their cumulative 8% return. A 70-30 split is pretty common with the preferred return, but we've also seen 80-20 splits, giving more to the LPs, but without a preferred return. The type of splits that you're going to see on a deal, it's really deal by deal basis, and it really depends on how the deal sponsor decides to structure their respective deal that they're offering. Okay, so this bottom row, it doesn't necessarily cover returns, but it does have important information that investors are going to want to know, such as setting expectations around how frequently the cash distributions are going to be made to investors, when that first distribution is going to be made, what the minimum amount to invest is going to be, and how long the holding period is estimated to be. So going through this, we calculated cash on cash return on an annual basis. It can actually be broken down and distributed monthly or quarterly. In this case, the deal was planning to distribute quarterly as indicated in the first box that's highlighted. So when is that first distribution was planning to be made? In this deal, you can see that they plan to make their first distribution 6 to 9 months after the deal has closed or been fully acquired from the seller. The reason for this is just to allow enough time for transition of management from the old owner to the new owner, and for the new owner to start implementation of their business plan for the property. Now, if you had wanted to invest in this deal, the minimum investment was $50,000. It can range from $50,000 to $100,000. And then finally, the holding period. In this case, it was projected to be 5 years, but it can range to be more or less. Keep in mind, though, for those investors who want to participate in these private placements, investments, you should know that this is a long-term investment. So if you think you're going to need the money, invest money sooner, say for a down payment for a house in a year or two, it might not be a good idea to use it in these syndications. So I'm just going to quickly go over the type of targets we look to offer in the deals, our deals, for our investors. So we usually like to structure our deals to have a preferred return being offered to our investors, generally at the 7 to 8% range. We also like having cash on cash returns of 10% or more, 100% of total returns or 2 times equity multiple, and target 15% or more of IR. We also like to structure our deals to have a 70-30 split, and we look to hold our investments at least around 5 to 7 years. So I know we went over the terms. Jin's not going to show you what your returns might look like in actual dollars for the same $100,000 being invested, similar to this deal. Jin?
Thank you so much, Lana. So now we're going to take a look at these terminology and take it to another level by showing you what they look like in numbers. So this is a table that you would typically see in an investment presentation. The purpose is just to illustrate to you what the returns are expected to look like, assuming that you invested $100,000 in this deal. And we're only using $100,000 just because it's a simple number to do math with. So let's focus on the cash on cash because those are the first 2 rows on this table. So in this scenario, this investment is essentially projecting that in year 1, you could receive 10% cash distribution. So that's $100,000 of your investment times the 10% equals $10,000 in your pocket. In year 2, you could expect 4 checks in the mail, totaling $10,000 in another distribution, and so forth. So according to this projection, at the end of year 5, if you receive all the cash distributions, it would total up to $50,000. And so that is the beauty of investing in that's the beauty of investing in a syndication, where you're putting your money to work in a cash flowing real estate deal. You didn't really have to do much for that $50,000 in cash distribution. I mean, you probably had to work really hard to make that $100,000 to invest with, but that $50,000, you didn't really have to do much for it. In fact, I don't think a single tenant would not have called you with any toilet problems during this entire time, and you would continue to get these checks in the mail. So that is what we call passive income. And that is not all, guys, because when the property sells in year 5, that's when everybody gets their payout, the big payout. So after all the debt and all the liabilities have been settled, then investors are next in line. As you can see, you will get your original investment first. So that's called the return of capital for $100,000. And what I'm going to say next is not really illustrated on this table, but let's say that, if the investment wasn't able to pay you that 8% preferred return each year during the life of the investment, in that case, then you will be made whole on that preferred return at the time of the sale. So $100,000 times the 8% pref would be $8,000 a year that you could be expecting, but you don't get it. So then let's say $8,000 times 5 years, that would be $40,000 over the course of this investment. However, let's say that you were, that this deal was distributing and you end up actually getting $50,000 in cash distribution. In this situation, that's really good because there's nothing more to do to make you whole, because you actually received distributions much greater than that 8% pref. So that's really good news. And then any remaining proceeds after that will be now split 70% to the limited investors, the limited partners, and 30% to the general partners. So in this case, it will be another $61,000 in capital gains to you. And as you can see, this deal in total is projecting it will generate a total return of $211,000. And that would be the sum of the cash on cash, $50,000, plus your return of capital, which is $100,000, and then $61,000 from the proceed from sale. And now the bottom row here, I want to talk to these numbers as well and show you how they're calculated. See, the total return here is 111%, and the yellow highlights, it correlates to the yellow highlights on the table, is showing that this is calculated by taking the $50,000 from the cash on cash return. $50,000 is really 50%, and then the $61,000 from the proceed of sale, $61,000. So when you add 50 plus 61, it gets you to that 111%. And then the cash on cash average, that's really simple math. It is just taking that 50% that you're expected to receive in cash distributions during the life of this investment and dividing it by the holding period, which is 5 years. So that's an average 10% right there. And then the internal rate of return, this one's a little bit harder to show you how it's calculated, but it is just the annual average of the cash on cash return and the proceed from sale discounted for the 5-year investment period. So the discounting is the part that's a little bit hard to show you how it's calculated, but that comes to 18.5% per year. Now, this is pretty much a project that goes from beginning to end. Maggie is now going to show you an example of returns we've been getting on one of our deals. Keep in mind that this project, it is still ongoing, so we don't have the final return figures yet to share with you, but we just want to share with you guys the story behind the deal and the return that it is generating for our investors so far. So Maggie?
Thanks, Jen. Hey guys, so here is an example of an actual project that we worked on. It's called Penn Oaks Acres. It's 152 units. It's built in 1968. It's located in the Kansas City MSA, which is home about 2 million residents. And we acquired it in March 2020. And so it's coming up about a year now. Interesting story about this property, it was actually owned by a church. So if you can imagine, it's actually operating more like a non-for-profit rather than for-profit entity. The physical property itself was pretty good shape. The challenges, or rather the opportunities that we inherited were, as an example, out of the 152 units, about 100 units were on month-to-month leases. And also rents were rarely increased. In fact, there was one tenant who was living there since 1970s who hadn't had a rent increase. So there was a bit of transformation process that we had to go through. The business plan included improving the interior and exterior of the property, converting all the month-to-month residents to annual leases, increasing the rents, and streamlining expenses. On the screen, you can see some of the rehab that's done. The picture on the left side of the screen with the interesting brown cabinets was what it was originally. And 3 pictures on the right shows the renovation that we done. So we painted the cabinets, updated lighting, updated flooring, updated bathroom, and just freshened the paint throughout the property. If you're curious to hear more about the details, we can definitely talk more, but you guys are here to hear the actual versus projection. So let's get into it. This deal was projected 10% cash on cash. So fast forward, we're just shy away from a year from acquisition. Occupancy is now at 95%. It was 89% at acquisition. All tenants are converted annual leases. The other good thing about that I'd like to share is that this property has a really good mix of 1, 2, and 3 bedrooms, with 3 bedrooms accounting about half of the property, half of the mix. At acquisition, for some reason or another, the 3 bedroom and the 2 bedroom were rented out around the same rate, around the low to mid 600. Today, the 3 bedrooms are now rented at $950. That's almost $300 rent bump. So we are very happy to say that we're slightly ahead of our projection in terms of operating income. What this all means is that we are very good, we're in very good position, and we feel very comfortable to meet and distribute our year 1 cash on cash returns of 10%. And we are on track for year 2, despite the pandemic. We also are very happy to report that one legacy resident from 1970 is still with us today. Even though we had to increase his rent, he wasn't totally thrilled, of course, but there is a balancing act. We didn't go in day 1 and just demanding higher rents, even though the market can support it. We took the time to really fix up the property exterior, like landscaping, sidewalks, railing, things that tenant can actually see. So when it comes to the conversation of rent increase, it doesn't really come as a surprise, and it was a little bit more tolerable. So we're glad that our legacy tenant did appreciate our efforts and the improvement that we made in the community. Next slide, please, Jen. And here's an example of a happy investor that was in the Penn Oaks deal. He actually saved his first distribution check and taped it up on his wall, along with his financial goals underneath this check. You can't see it in the screen, but and I don't think he realized, but when he sent this picture to us, it made our day. It's such an honor and rewarding feeling for us to be part of his investing journey and financial goal. And this is one of the reasons why we love our job. We get to help our investor achieve the financial goals, improve the communities that we and our tenants' lives, and also work with great partners to solve problems every day. So without further, I would like to pass it back to Jen.
Thank you, Maggie. So we can now answer any questions that you guys may have. And while we wait for questions to come in, okay, I don't see any questions yet. And so while we wait for these questions to come in, I'd like to invite you guys. I think most of you guys are already in our investor circle, but if you're not, it would be great if you guys do join. And if you know friends or family who you think might be interested in these type of investment opportunities, we would appreciate you telling them about this. And I'm sure they would also appreciate you telling them about it as well. So as what we do here are private investments, we do have a duty to know who our investors are. So if you have friends or family who wants to join our investor circle, you can send them to our website, sageinvestinggroup.com, and click on the Join Now button, fill out a questionnaire, and we simply need to just set up a call with them. They need to set up a call with us, really, and so that we can talk to them and get to know them and their investing goals better. And once the person signs up, they will get our newsletter and other communication from us. But like I said, we won't be able to send any deals until we've had a conversation with them. And the Sage Investor Circle is really great for anyone with all range of investing experience, whether this is new for you or you've been investing all your entire life, and whether you're doing this on the side or this is something that you're doing full time. Or even if you haven't invested in a deal yet, or maybe you've invested in 10 other deals with other operators, the Sage Investor Circle will offer you different opportunities for you to invest in. Now, if you guys have other topics that you want to see on our future webinars, feel free to email us at info@sageinvestinggroup.com. And with that, that's our presentation. And I don't know if we have any questions. Let me see.
Jen, can I ask you a question? This is Bob.
Oh, hi, Bob. Yes.
If the expected rate of return exceeds, the planned distributions, how is that given out to the limited partners or general partners? Let's say the property is earning and doing quite better than projected. Does that get split typically a certain way?
Are you talking about like the operations, right? The property is operating and generating a higher, net operating income than we had originally projected? Are you talking about that?
Right. If you're bringing in much more income than projected, the rents are going up a lot quicker. How is that typically handled for limited partners? How are they paid out if the project does much better than anticipated? Do they just get an extra return at the sale, or do they typically get higher distributions?
Thanks, Bob. That's a really great question. So in this scenario where our investment is actually doing better than we have projected, then we would calculate the distributions as follows. The investor would get allocated out their pref return first, and then any remaining money after that will be distributed 70% to the investors, and then 30% to the 70% to the investors and 30% to the general partners. So if that remaining piece of pie is bigger after the pref return is allocated, then that means the limited partner will end up getting a higher distribution, and they will be also rewarded for the greater performance at the property. All right, did anybody else have any other questions? All right. If no other questions, we'd like to thank you guys for joining us today. We hope you found it very helpful, and we will continue to try to bring more informative webinars to you guys to help you learn this process and help you make good investment decisions. So thank you. We will go ahead and send you guys a copy of this recording once we end the webinar.
Thank you.
Thank you, everyone.
Thank you.
Thank you. There. Bye-bye.